Hey, what's up guys? So personal finance should be something simple, easy to understand, and something that everyone should learn when they're growing up. But because it's become such a massive industry with so many interests at play, there are many words that are quite complex and unfamiliar to the majority of people, and it's for a reason, obviously, because they want you to not understand the jargon so that you need them, and then obviously it fuels and more money goes into it. But that's beside the point. So in today's video, I'm going to be trying to explain it and hopefully simplify this terminology so that we can all actually get ahead and not get screwed up. I'll have timestamps down below so that you can skip to any section that interests you a bit more, or if you kind of don't want to learn about some certain sections, you can just skip right over. P.S. This is part 1 of 2 because there are a lot of terminology. There's so many, and I didn't want to make this video like 10 hours long. So without further ado, let's just jump into it. Firstly, there's APR, or annual percentage rate. APR is the annual rate of interest that is levied against borrowers and paid to investors. It's typically shown as a percentage, making it easier to compare it with various lenders. For example, if you borrowed £100 on a credit card at 27% APR and didn't pay it back, after a year, you would owe £127. Another thing you'll hear is bonds. A bond is a loan made to a company or government in exchange for interest payments and the return of principal at a later date. When you buy a bond, you're lending your money to a company or government in exchange for a promise to pay you back the principal, which is also known as the face value of the bond when it matures, as well as interest payments at a specified rate. For example, if you buy a £1,000 bond with a 5% annual interest rate, you will receive £50 in interest each year until the bond matures, at which point you will receive your £1,000 back. The interest rate on a bond is called the coupon rate, and it is the percentage of the bond's face value that the company or government will pay you in interest each year. Another one is capital gains tax. Now, this is quite an important one, so I'm going to take a little bit more time and go a little bit more in depth with this one. The basic idea of capital gains tax is... I'm not really joking, but whatever, I'm joking. The real basic idea of capital gains tax is that you must pay tax on any profit that you make when you sell an item, stock, or asset. Similarly to income tax, there are also additional capital gains tax allowances for each tax year. The current capital gains tax allowance for this year is £12,300, meaning this is the amount of profit you're allowed to make before you have to pay tax. The sale of art, business, second homes like vacation homes or buy-to-let properties, and shares in funds that are held in a general investment account, because if they're held in an ISA account, they're not taxable, and any other assets that can be considered investments are all subject to capital gains tax. Now, if you're married or in a civil partnership, you can share your tax allowances, meaning that for this tax year, the couple's allowance is £24,600. You can also transfer asset ownership between the couple without having to pay capital gains tax. So there are different capital gains tax rates depending on how much you earn and whether you're selling an asset or property. If you earn below £50,270, which is a weird specific number, you are considered a basic rate taxpayer, which means you'll pay 10% of the profit when selling an asset and 18% when selling a property. If you earn above that previously stated specific number, this will mean that you're considered as a higher or additional rate taxpayer, which means that you'll pay 20% on the profit of that when selling an asset and 28% of the profit when selling a property. But remember that you only pay tax on profits. So if you buy something for £1,000 and then sell it for £25,000, you will have made a profit of £24,000, of which £12,300 will be tax-free in the allowance, leaving only £11,700 to pay tax on. Okay, that's enough with capital gains tax. Let's go on to commodities. A commodity is a basic good or resource that is used in commerce, and it is most often used as the input to the production of other goods and services. An easy way to think about it is that a commodity is a raw material that's used in the manufacturing of finished goods. Some examples of commodities are gold, copper, oil, and wheat. Next are credit checks. When you apply for a loan, a credit card, a mortgage, or any type of borrowing, a credit check is done. In general, it involves the business checking your credit report to figure out your likelihood of repaying the money back. Your eligibility to receive the loan or credit card is determined by this. But remember that credit checks will normally appear in your credit report in the future. Next is a debit card. Everybody kind of knows what a debit card is, so I won't make this quick. A debit card is a payment card that will be given to you along with your current account. It can be used to make purchases, with the cost of the purchase coming directly from your current account. Next is direct debit. A direct debit gives the company permission to take money from your bank account at a specified date. For example, if you're subscribed to something like Netflix, Disney Plus, Amazon Prime, the cost of this will usually be taken by the company automatically from your bank account on a regular basis, like monthly or bi-monthly or however many times a year that it is specified in the subscription. The next one is disposable income. This is technically only personal current income, for example, your salary, minus current personal tax. However, disposable income is often referred to as the amount left over after all basic needs have been taken care of, like accommodation, food, and household bills, etc. The second last thing I'm going to be going over today is dividend yield. This is shown as a percentage and is the ratio showing how much the company will pay to its shareholders for owning a share of its stock divided by its current stock price. And lastly, ex-dividend date. Investors are deemed on record and qualified to receive a dividend payment from the company if they purchase a stock before the ex-dividend date, which will automatically be added to your brokerage account on the payment date. That specific dividend payment wouldn't be available to investors who purchased the stock after the ex-dividend date. That's all I got for today. Like I said at the beginning of the video, I'm going to be doing a part 2 because there's a few more things that I need to talk about. And like I said earlier, I didn't want to make this video like 10 years. So I'm copying the many movie strategy of doing 2 parts to make it a little bit more digestible. So hopefully I didn't bore you too much this video, and I made things a little bit simpler, and now you can go out there. And thanks for watching, and I'll see you in the next video.